All right, everyone, welcome. Today, we're going to dive into what is truly a cornerstone of all business and finance, the accounting cycle. Now, I know the term might sound a little dry, but this process is the engine that drives financial clarity in every single organization, from the coffee shop down the street to the biggest multinational corporations on the planet. And let me be clear, understanding this isn't just for the accountants in the room. This is a fundamental skill for any of you who want to lead a business, interpret financial data, and make the kind of informed decisions that lead to real, sustainable growth. So let's think about this for a second. Picture a company like Starbucks or Amazon. Every single second, thousands of things are happening. Sales are being made, returns are being processed, suppliers are getting paid, salaries are going out. Each one of those events creates a piece of financial data. So how does a business of that insane scale keep track of it all? How do they make sure every single dollar is accounted for, that their financial reports are actually telling the truth about their operations? Well, the answer isn't magic. It's a structured, disciplined process. You see, this constant stream of financial data, it's like a flood. It never stops. And if you don't have a system, a really robust system for managing it, a business's financial records would just be a chaotic, unreliable mess. And if your records are a mess, it's pretty much impossible to know how you're performing, to make smart decisions, or to report to your investors and banks with any kind of confidence. This is the fundamental challenge that accounting was designed to solve. Every single one of those transactions, no matter how small, creates data points. You've got the date, the amount, who was involved, what it was for. For a big company, we're talking about millions of these data points every single day. The real challenge and the beauty of accounting is how we capture all of that raw data accurately and then transform it from just a pile of numbers into meaningful financial information that actually tells a story about the health and life of the business. So, to handle this challenge, businesses rely on what we call the accounting cycle. Think of it as the structured step-by-step game plan for identifying, analyzing, and recording everything that happens financially in a company. It's a methodical system that ensures all this data is processed consistently and accurately, which gives us that reliable foundation we need for all of our financial reporting and analysis. So here's the textbook definition. It's a series of steps that starts when a transaction first happens and ends with the creation of our financial statements. Now, the key words here are record, classify, and summarize. They are the core functions of the whole cycle. So what do they actually mean? Well, to record is to make that first note of a transaction, in a journal. To classify means we sort those transactions into different groups, putting all the similar ones together in a ledger. And finally, to summarize is to pull all that classified data together to build our reports. I really like this way of thinking about it. The accounting cycle is basically a translator. It takes all the raw, chaotic activity of a business, selling things, buying things, paying people, and it translates it into a standardized universal language. That language is accounting. And just like any language, it has rules. We call those rules generally accepted accounting principles, or GAAP, here in the US. And in many other places, they use International Financial Reporting Standards, or IFRS. This common language is what allows us to compare one company to another. Okay, so now that we know what the cycle is and why it's so important, let's roll up our sleeves and really deconstruct it. Let's look at each of the core steps in detail. By the end of this, you'll have a much deeper understanding of how this financial information gets processed, and more importantly, how you can critically evaluate that information when you're out there in your careers. We can really break the cycle down into 4 key stages. First up is journalizing transactions. That's where we record every event as it happens in chronological order. The second stage is posting to the ledger, where we take that information and organize it into specific accounts. Third, we have adjusting entries, which we do at the end of a period to make sure we've captured all the revenues and expenses that belong in that period. And finally, stage 4 is making the closing entries, which basically wipes the slate clean on our temporary accounts so we're ready to start the next accounting period. So the journal is like a daily diary. It's a chronological record of everything that happens, and every entry we make is where the magic of double entry bookkeeping happens. You see, for every single transaction, there has to be at least one debit and one credit, and the total of the debits has to equal the total of the credits. This is what keeps our fundamental accounting equation in balance. Assets must always equal liabilities plus equity. Then, we take that diary and we post it to the ledger. The ledger is more like a master organizer. A binder with tabs for every account. Cash, sales, rent, you name it. It takes all the scattered diary entries and groups them together. This step, moving the info from the journal to the ledger, is called post. Now, these last two steps are absolutely critical for making sure our books are accurate, especially under what we call accrual basis accounting. This means we recognize revenue when we earn it and expenses when we incur them, not necessarily when cash changes hands. Adjusting entries help us do that. Think about it. Let's say your employees worked the last week of December, but you don't actually pay them until January. Well, you incurred that wage expense in December, so you have to record it there with an adjusting entry. Closing entries are the final cleanup. They zero out all the temporary accounts, like revenues and expenses, and move their net total into a permanent equity account, like retained earnings. This gets the books ready for a fresh start next period.
And all of this work, it brings us to the ultimate goal, the whole point of the accounting cycle, creating the financial statements. These reports are the culmination of the entire process. They are the primary tool that everyone, from the CEO to a potential investor, relies on to make decisions.
Every single step we just talked about, from that initial journal entry to the final closing entry, is meticulously designed to make sure these final reports are accurate and reliable. You have to remember, these statements aren't just a boring accounting exercise. They are powerful, vital tools for making critical decisions. So, the three main financial statements you'll work with are the income statement, the balance sheet, and the statement of cash flows. The income statement shows you a company's performance, its revenues and expenses over a period of time, like a quarter or a year. The balance sheet is different. It's a snapshot at a single point in time. It shows what a company owns, its assets, and what it owes, its liabilities and equity. And it always follows that core equation, assets equals liabilities plus equity. And finally, the statement of cash flows tells you exactly where cash came from and where it went. Now, these statements are essential for judging a company's health. An investor might look at the income statement to see if a company is profitable. A bank will look closely at the balance sheet to see if the company can pay its debts. But here's a common mistake I see students make all the time. They look at just one statement in isolation. You can't do that. A great manager has to use them together. For example, a company could look great on its income statement, showing a huge profit, but its statement of cash flows could reveal it's actually burning through cash. That's a huge red flag. Understanding how these statements work together is absolutely critical. At the end of the day, the integrity of these financial statements is everything. Investors, creditors, employees, everyone has to be able to trust that the information being presented is accurate, reliable, and not biased. The accounting cycle, with its systematic and disciplined approach, is the very foundation of that trust. So the whole cycle is really guided by these three main goals. First, accuracy. The system of double entry bookkeeping, where debits must equal credits, is a built-in error checking mechanism. Second, compliance. Following the rules, like GAAP, ensures that we're all speaking the same financial language, making companies comparable. And third, and this is a big one, is to correctly represent the company's financial position. This means the statement shouldn't just be technically right, they need to present a true and fair picture that isn't misleading. This quote right here, this really gets to the heart of it. The ultimate goal is to produce financial information that is both accurate and honestly reported. This is absolutely essential for maintaining the trust that our entire economy is built on. When that trust breaks down, when financial information isn't reliable, people make bad decisions, and that can lead to devastating financial losses. So in the end, the accounting cycle is so much more than just a mechanical process of crunching numbers. It is a vital system that underpins the integrity of our financial markets. As future business leaders, it is absolutely imperative that you understand this cycle inside and out. It's what will enable you to make smart decisions, to manage your organizations effectively, and to contribute to a business world that is both transparent and accountable.